Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Mr. Shankar, Managing Director of Redington, India, joining in. Welcome to the show, Mr. Shankar, and a pleasure to have you as well. My first question coming to you right now is that last 1 year we've seen unprecedented times. I think no business, no sector, no economy has been really saved out of this. And COVID has had some serious impact as well on a global basis. However, the kind of numbers that we see that Redington has delivered in the third quarter of FY21 and the growth that we've seen on a year-on-year basis for the first 9 months of FY21 also has been pretty strong. What would you actually attribute this kind of performance to?
Interesting. First of all, Hiral, uh, thanks for inviting me. It's really a pleasure to connect with you. To your question, I don't think there is anybody, whether it's an individual, whether it's a company, or whether it's an economy, every single entity has been impacted one way or the other.
Hmm.
And if there are some fortunate few who thus far have been probably not yet impacted with the COVID-19, yet some of their family members and some of their own kith and kin have been impacted. So I first must admit that we are certainly not insulated. We've also been impacted across all our locations in India, as well as in Middle East, Africa, and Turkey. But I must tell you something that I say with tremendous pride and, I don't know, seriously something that I'm proud of. That while there have been a number of cases in India, just to give you a sense, thus far, about 60 of our employees in India, out of a total 1,500 employees, were tested positive. And as we speak, not a single person is now continuing to undergo treatment. Everyone has since been tested negative. Similarly, when you look at outside India, we have close to about 2,000 employees working in Middle East, Africa, and Turkey. Here again, I must tell you that we have close to 140 of our colleagues who were tested positive during this entire 9-10 months. But as we speak, we still have about 20 who are undergoing the treatment, and this is largely in UAE, Saudi Arabia, and we also have an operation in India, which is the center of excellence, where again, there are some people impacted. So the first point that I want to submit to you is, in relation to the total number of employees we have, I think the number of cases have been under control. And fortunately for us, most of them, if not all of them, are since out of danger. Now, we have taken a lot of precautionary measures. So, for instance, we clearly, for the first 3 to 6 months, did not even allow people to come to office, even though there could be probably 10-15% who would have still made it to the office. Otherwise, we completely stopped people from coming to the office. It is only in the last 3-4 months that now we have about 40-50% of our people in India work from office. And in overseas, it's about 60% of our people work from office. So the rest work from home. So the good news is that it seems to be working thus far. Our IT system has been able to cope very well. And fortunately for us, I think we have managed it very well. I'm fond of saying this, Hiral. I'm not sure this is the right time to say it. I would always say that a typical Reddingtonian is someone with a good IQ, with a better EQ, but the best AQ, which is adversity quotient. The ability to face adversities and always come out, winner and come out better is a typical trait of a Reddingtonian. And as we talk during this session today, I will have many more instances to talk about how a typical Reddingtonian is able to face, every adversity, whether it's personal, professional, or, market related.
Right. I mean, that's a good point that you've made, Mr. Shankar. Now, one question is that distribution as a business is highly competitive. Margins are relatively low. However, when we see the financial performance of the company for the last couple of years, it's been pretty consistent. The improvement that we are seeing on the balance sheet as well, especially, I mean, if I have to look at the revenue growth, 11% CAGR is what we've seen from FY15 to now. EBITDA, 7% CAGR. Similar CAGR growth in terms of profitability as well. And the ROCE has seen a substantial improvement in FY20. Now, taking all of these numbers into consideration, if you could just help us understand what is it in terms of business, what is it in terms of strategy that is working well for a Redington?
You said it very correctly, Hiral. The gross margin in the distribution business is typically 4 to 6%. And by the way, this is true for all distributors on a global basis. But what makes it interesting for us to continue to be in the business is the returns, which you also pointed out quite rightly. The ability to make money lies in the successful management of deploying working capital, thereby leading to a higher return on capital employed. So, as you would have observed, that in FY19, our net working capital was 37 days. So in other words, we were able to rotate the capital about 9.8 turns. In FY20, we brought down capital to 30 days, thereby improving the working capital turns to 12. And by the way, in this pandemic period for the last 9 months, we have managed to further beat it down to just 14 days. Mathematically speaking, this is about 25 working capital turns. Honestly, one of the best in the industry, and we have set a gold standard. Now, besides this, so if you ask me, what is it that makes this business as interesting as I make it out to be, there are 5 or 6 areas that we are heavily focused. One, I have already mentioned about the efficient deployment of working capital. The second is in our ability to have an enviable relationship with our vendors and partners. Hiral, trust me when I say that we have been in this business for 27 years. I say with a lot of pride and of course humility that we have not lost a single contract. So the kind of enviable relationship that we have with the various global technology vendors puts us in a different pedestal. Third, very importantly, this business is about very strong execution. And I think over a long period of time, we have demonstrated our ability to execute extremely well through the thick and thin of it. Very importantly in this business, you have to keep driving growth by constantly adding new product categories, adding new brands in those categories, and expanding your footprint across various markets. That's another very important aspect. And last but not the least, very importantly, to have a superior professional management team.
Mm,
It may sound like a cliche, Hiral, but I must tell you, our team is second to none. You know, if you permit me, I'm fond of saying something that I tell a lot of my colleagues and many of the investors. They say a professional is a subject matter expert. An entrepreneur is someone who takes a risk for a reward. But if you employ a professional, give them the empowerment to think and behave like an entrepreneur, they become Redingtonians.
mm,
Hiral, it may sound like a mouthful, but if I told you that there is no promoter in this company, so it's very interesting, and we will talk about it probably later during this session. It really begs the question, how has this company managed to sustain itself and continue to grow? You mentioned some statistics, and if I may, on closing, say
mm,
that we were listed in 2007.
mm,
In the 13 years that we are listed, our revenue CAGR is 15%.
mm,
Our EBITDA CAGR is 14%. Our profit after tax CAGR is 13%. So here is a company that from listing over a 13-year period has consistently executed and delivered superior results. I'll take a pause there.
mm. So with this, an important statement that you made over here is that the transition that we've seen for the company from a promoter-driven organization to a promoter-free organization, which is professionally run, has this actually changed the way of working? Has it changed the business strategy? And have we seen results on the financial front as well?
Thank you for asking that question, Hiral. I was just waiting you would ask me that. You know, very interestingly, Redington has been always a professionally managed and a board governed company since its inception in 1993. Very few people know this, that Redington was actually set up with a small seed capital from the then financial sponsors called Kevalram Chandrai family. They invested in this company through a vehicle in Mauritius called Redington Mauritius Limited. And when the company went public in 2007 and we listed in the National Stock Exchange, Redington Mauritius became, RML became the promoter. Now, you would know, Hiral, better than anyone else that SEBI would typically make an individual as a promoter. We got an exception to have a company as a promoter. That happened in 2007. That still doesn't answer your question. From 2007 until the time the financial sponsor or promoter exited the company, they did not even sit on the board. So it begs the question, Hiral, that here is a financial sponsor whom we call promoter by SEBI definition. They had invested in the company. We built the company. We nurtured it. We took it to scale. We listed it. And when the company went public, they were not even sitting on the board of the company.
Mm,
So the fascinating part of this journey is that here is a company that has always been managed professionally and governed by a very strong board. Now, here is another interesting aspect. In the last couple of years, there is now a very strong, shall we say, a mandate towards a chairman being independent. Can you believe again, Hiral, if I told you our chairman is an independent director who came on board 1 year before we went public, that is in 2006.
Hmm.
He continues to be the chair until today, and he's an independent board member. And if you look at our board, we have such a distinguished board of 10 members, 50% of whom are independent directors.
Hmm.
And these are people from absolutely diverse experience, whether it is in the field of technology distribution. There is one who has worked with a global technology vendor for 17 years in a very senior capacity. We have someone who served as a partner with a Big Four for 30 years. He chairs our audit committee. We have someone who's deeply specialized in human resource management and leadership development. So we have a fantastic board, and it's a great privilege to be able to work with a very distinguished board, and we are able to benefit from their experience and expertise. So the point I want to submit to you finally is, with a fantastic board, and the other thing that I want to tell you about our people. If you look at the leadership team, this is a team who have stood by the company and who are a very driven set of people,
Hmm.
most of whom have an average age of 15 years with the company. It's incredible. They are all professionals, very qualified, whether engineers or engineer MBAs or chartered accountants or data scientists.
Hmm.
But these are people who are truly committed. And this company has come a long way, partly because of a very strong, professionally committed team, as well as a very strong board.
Absolutely, and it's clearly seen in the way the earnings are panning out as well. Now, with this, Mr. Shankar, IT enterprise as a business has been one of your growth drivers as well, especially when we look at margin expansion. That's where it's coming from. Now, if you could just help us understand what is the plan ahead with this business, and are we looking to exploit the earnings opportunities that could be laying on this segment of business?
Thank you, Hiral, for that question. You know, if you look at the way this company has evolved over time, what started off as a distributor for one brand in one country, that is India, 25, 27 years ago, today we boast of having distribution contract for over 230 plus global technology brands. We address one market then, we are addressing today over 37 markets and counting. We were started off with only distributing printers. To today, we have PCs, printers, software, servers, storage. So we cater to both the consumer segment, and we also cater to the enterprise. What again, few people probably are not fully aware is that our sweet spot is the SMB. You know, when a lot of times people look at us and say, hey guys, you seem to be competing in some sense with the IT services companies. But the truth here is they are addressing the Fortune 25, the Fortune 50, maybe the Fortune 100 companies. But since SMB is our focus area, we are targeting a completely different set of customers, both in the SMB and the mid-market space. Now to your question specifically. The way we have evolved very quickly, Hiral, is from distribution 1.0, we moved about 9 years ago to distribution 2.0, and now 2 years, we are evolving and making our foray into distribution 3.0. So your question will be, okay, what is all this 1.0, 2.0, and 3.0? Very simply put, 1.0 is all about achieving efficiency. It's about logistics efficiency. It's about capital efficiency. It's about cost efficiency. And it's all about driving scale, which is exactly what we have done. Distribution 2.0, which we started about 9 years ago, is all about in the IT enterprise space. We, we are adding, in addition to the logistics and the credit that we offer to our partners, we are involved in providing value added services. And this is the most important. And these are in the nature of, let's say, we do pre sales consulting. So, what it would mean is that we would go along with the partners to the end customer and help to design solutions. So, this is a very important value addition. And we also try and partake in professional services, implementation services, etc. So, this is briefly about 2.0, where we are relevant and adding value to both vendors and partners. Distribution 3.0 is very simply put, moving into as a service model. So, as the world is moving, surely from a capex to an opex, more and more of the customers are saying, hey, you know what? I don't want to be investing huge amounts of money in data center. That's not my core business. Why don't you give me your services as a fee? So I'm willing to pay you on a monthly basis, but you provide all the services to me. Similarly, from a transaction business, it is moving to annuity or subscription business. What would happen until recently is we would be selling some servers and storage and workstations to our customers. Now we are starting to sell on a regular monthly basis, on an annualized basis. We are getting into multi-year contracts where there is a recurring revenue. So there is a monthly recurring revenue, quarterly recurring revenue, and annual recurring revenue. So from a transactional revenue, it is now becoming a contractual kind of a business. So with all the shift, we are clearly positioning ourselves as a company that can provide as a service model to more and more of our partners. We were one of the first in India distribution to be appointed by some of the global vendors as a CSP, a cloud service provider. Today, in addition to providing or reselling the cloud, whether it is for AWS, whether it is for Microsoft, Azure, etc., we are also providing the managed services, whether it's about migrating or helping customers to migrate their workload from on-premise to the cloud, notwithstanding that some of these could be critical workload. So fundamentally to your question, therefore, Hiral, how does margin expand? From moving from efficiency business to value added business to now as a service business, our margins are consistently expanding and will get much better over time as the services business starts to see scale.
Right. So what percentage of revenue are we expecting from the services business over the next 2 to 3 years?
Okay, let me put it this way. More than revenue, Hiral, services business should be measured in terms of profit contribution. So if today the profit contribution from services, since we have started only recently, could be a very small couple of percentage points. But when you look at over the next 5 years, 10 to 15% of our profits would come out of the services business. And that is going to be an absolutely margin rich, profit interesting business.
Right. And this, another question that I have is with regards to where the different markets go. Now, when we look at India and overseas, on a gradual basis over the last couple of quarters, we've seen that the revenue from the Indian business is also increasing. I think from the third quarter of FY20, we were at around 35-36%. It's moved up to 45%. Whereas if you see on the profitability front, you have the overseas business, which is generating higher profitability, and that's gradually increasing, whereas the profitability of the Indian business is gradually decreasing. So are we expecting this kind of trend to continue? Or do you think there would be, changes that could come in on this front as well?
So thank you for that question, Hiral. You seem to have done quite a bit of research about Redington. Thank you for that. So the first point, Hiral, if you look at the way overseas has grown and the way India business has grown, overseas over the last, since listing, has grown faster. To give you a sense, overseas has grown by 18% revenue CAGR compared to India's 11% revenue CAGR over this last 13 years. And hence, you would remember I said 15% is our revenue CAGR at a consolidated level. Now, what is interesting is this. Until about a year or two ago, close to 67% would come in terms of top and bottom line would come from overseas. And you know what change is happening now, Hiral? India, in spite of the fact that overseas is growing, India is growing much faster, both in terms of top and bottom line. So to give you a sense, for Q3, if I took that in isolation, 45% of the total revenue came from India. Whereas it was 33-35% until about a year or two ago. And if I therefore take for the full 9 months, 40% already of our business is coming from India. So the first point I want to make to you is, as you look at the way forward, you would clearly see India growing faster, and the contribution from India will exceed 50% in the next 1 to 2 years in terms of top and bottom line. But I hasten to add here, now it is only because India is going to grow significantly faster compared to overseas. Overseas will grow, but on a different note, between Redington's overseas revenue and the second player, who's our competitor, they are just 1/3 of our revenue size. So we already have a pole position and have leading market share for most brands on the overseas terrain. But in India, now we are really now scaling our business. I'm very pleased to share, even if you take Q3, we have grown faster than the industry in India. So to your point, trust me when I say that India business over the next 3-5 years will grow much faster, and in terms of contribution will be much higher compared to what overseas has been doing thus far.
Right. So with this, will the value creation also be as good? Because clearly when we see the value creation, it's almost 27-28% with regards to where the overseas business is concerned, whereas it's around 23-24% when you talk about the Indian business goes. So will the value creation also be faster like that? Or how are we seeing that? I mean, what average percentage terms are we talking about over the next 3 to 5 years?
So, when I talked about growth, as much as top line, it is about bottom line. You remember we talked about the margin expansion in the enterprise business. We are making big strides into the enterprise service space. We are making big investments, and now once again, building our ProConnect business, which is our logistics business.
Mm.
And by the way, ProConnect, even during the pandemic, has delivered a 10% EBITDA. So the point I want to make is as we fast forward the next 3 to 5 years, whether it is the logistics business on the back of ProConnect, whether it is the services business or the IT enterprise services business, and we are also now, for many of our other businesses, also now raising the bar in terms of margin expansion and becoming a lot more cost efficient. Our operating leverage is now becoming very interesting. So as we continue to scale, you will see even our EBITDA margins becoming much better over time.
Mm. Right. So with this, as you mentioned about ProConnect, it's been very interesting to see that, in a year's time from a negative EBITDA and a negative and a loss, we've turned profitable as well as we've seen a profitable EBITDA as well. Are we expecting this kind of trend to continue from here on? Or do you think this is a one-off year and there would be some bit of slowdown that could be anticipated?
So the first thing, Hiral, you remember when we talked about the pandemic and there was lockdown for good part of April and part of May, and then there was partial lockdown for some time? In the logistics business, there is nothing called work from home.
Correct.
You have to be at the warehouse. You have to deliver, receive products, ship products, deliver to your customer. Now, if I told you that during this period, absolutely, we had amazing warriors at ProConnect. Hiral, I say with tremendous pride that Q3, we recorded the highest revenue in the history of ProConnect for any quarter. So the point I want to submit to you is that ProConnect is an absolutely finger-licking good business. Let me give you a few points which probably will make my case even stronger. Now, this logistics business was actually a part of Redington. It got hived off in 2012 as a separate subsidiary, which was called ProConnect. Now, when you look at this company prior to 2020 and look at a 5-year period, Hiral, you will be pleasantly surprised that our revenue CAGR was 44%. Our EBITDA CAGR was 52%, and our profit after tax CAGR was 46%. And by the way, what started off about 7-8 years ago, where Redington was the only customer for ProConnect, today, 100% of Redington's supply chain requirements are met by ProConnect, and yet the contribution of Redington to ProConnect revenue is only 13%. So which means we have become a true 3PL company focusing on warehousing, transportation, value-added services, etc. I am super happy with the fact that we delivered 137 crores of revenue in Q3, which, as I said, was the highest thus far, with a 10% EBITDA. Now to your point, how do we see this company in the way forward? We are clearly focused on expanding and growing our margin. You will see that we are going to be a premium logistics service provider focused on a few industry verticals, the likes of IT, the likes of pharma, e-commerce, etc. And we will want to be the preferred choice of a logistics service provider in that area. And this is something that we are committed to making it happen in the next 3 to 5 years. You will see we had a sort of a setback in 2020 But in our FY20, FY21, I had mentioned to the street that we are going to now correct, consolidate, and now set ProConnect for a growth path in the way forward. I can tell you with confidence that has been done. Now, in the way forward, this is going to be a crown jewel of Redington. Trust me, Hiral, this is a crown jewel which has still not been fully nurtured, polished, let alone brought to the limelight. Over to you.
Absolutely. It seems like it because it seems that all cylinders have started to fire for a Redington right now. So, taking that point into consideration, if we have to look at Vision 2025 from a growth perspective, what's the kind of uh, milestone are we ready to cross in terms of top line, bottom line, or even for that matter, in terms of the margin profile of the company? What would be the vision?
So, Hiral, this is a question that we keep thinking about all the time. So let me articulate it. It may not necessarily come out the way I would like, but I'll give you my 2 cents. By 2025, you would see Redington a fully digital organization. We will be focused on services and solution. Now, very important that we will continue to grow our core business. It is not that we are giving up our core business. That's extremely important and we will make it super efficient. But what we will also do is to go deeper into a few high potential markets like India. Thus far, our growth was on 5 vectors: grow by getting into new product category and adding brands, grow by expanding your footprint and getting into new markets, grow by increasing and improving your market share, grow by getting into new business adjacencies, and the last is grow by adding new customers. Now, what we are going to do going forward is grow. Instead of going broad and wide, go narrow and deep. So we will choose certain markets where we have built huge capability, deep domain knowledge, and we will want to make sure that we go narrow and deep and build and create value. That's another area we plan. The other area you would see by 2025, we would also be getting into new businesses beyond IT and mobility. That's going to be another interesting space. Now, we are currently doing the due diligence for some of those potential businesses or areas. And by in the next 5 years, we would have already sown the seed and started to, sort of scale it up. And last but not the least, Africa. Today, we participate in the English-speaking sub-Saharan Africa. Nigeria, Ghana in the west, Kenya, Tanzania, Ethiopia, Uganda, Rwanda in the east. But over time, you will see us now move into some of the other potential markets in Africa, which also we have built a lot of expertise and built a sort of a unique proposition that no other competitor is able to offer. And last but not the least, Hiral, sorry for that.
No, that's fine.
We desire to be a great place to work. I say with pride that we were appointed for 2 years in the top 20 great place to work in UAE. Now, we are now working towards becoming a great place to work in India and every other market that we worked for.
Right. But with this, I understand the vision, from a theoretical perspective. But from a financial perspective, what would it look like? Because if we see since inception, the profit CAGR has been around 13% on an annualized basis. Is that quantum something that we are looking at over the next 3 years, or something in the range of 15 to 20%? Any numbers that you could define for us?
Hiral, I used to say until about 5 years ago, 4 years ago, I used to call it 20, 20, 20.
Hmm.
So the first 20 is what I used to say then as earnings growth. The second 20 is return on equity capital.
Hmm.
The third 20 is the return on capital employed in the business.
Hmm.
These are the three important metrics.
Hmm.
Now, my point is the second and third 20 has not changed. We continue to be focused on, as a company, delivering a return on capital employed of 20% or north of it. Likewise, a 20% return on equity capital. On the first, we believe that 20% earnings growth may be a little hard to get,
Hmm.
but we will still want to be in the range of about 13 to 15%
Hmm.
as the earnings growth over time. And the other important aspect, Hiral, and if I didn't tell you, it wouldn't make sense. From 2007, when we hit the capital market, we raised about 140 crores.
Hmm.
In the last 13 years, I mentioned to you, we have delivered a double-digit growth, but Hiral, we never went to the capital market to raise money. So in other words, the entire growth was funded from our internal cash accruals. And by the way, just to tell you, in the last 5 years, 27% of our total profits have been paid as a dividend. And if you take the buyback that we did 2 years ago, it would be in the vicinity of about 33% is what we have returned to the shareholders. And this, in value terms, only the dividend amount would be a little shy of 650 crores. Does that give you some number sense here?
But with this, another question again I have is that yes, we did do a buyback earlier. That was 2 years ago. Now, the kind of cash flow from operations that we are seeing over the last 2 years, that's FY 19-20, and what is already done in FY 21 so far. Similarly, if we see the free cash flow as well, I think these are numbers which we've really not seen for a while for Redington. Now, taking these kind of numbers into perspective, what is the strategy that you would have from here on to create value for shareholders? Because do you think this is the best time where it would be time to augment a dividend payout or a buyback once again?
Hiral, you have hit a very important chord. Let me tell you something very honestly. Our shareholders have patiently invested with us and they've been happy the way we have executed.
Hmm.
It is very natural for them that during a pandemic year, for us to throw up the kind of cash that we have done is something that obviously has set the expectation high.
Absolutely.
The board is very clearly committed to making sure that we do something for the shareholders. It would be inappropriate for me on this call, with your permission, to tell you what exactly are we planning, because the year is not over. But the board is very clearly committed that we must do something. A, the company has done well, and B, the shareholders, who continue to be invested in us, we have to make sure that it makes it interesting for them too. I know I've not answered your question very directly.
No, I
It
know, but
seems to be a little bit of English, but you'll have to pardon me.
Absolutely, but can I interrupt over here? So, for example, I think when we commemorated our 10-year of listing, I think we did have a special dividend that was declared in the year FY17. So, taking the kind of performance that we've seen in the last 2 years into consideration, can shareholders actually expect something special in probably smallest of the words, maybe a yes or a no.
Okay, Hiral, so, you've been very kind to me. So I want to give you a feedback saying that, yes, they should be positive. They should feel that, yes, the company will do something. But let me tell you, different people have different expectations, and some of them have shared with me. All that I can only say is that I pray and I hope, and we will want to do something for the shareholders. That's a commitment. So the answer is yes, but how strong and how big is that yes in the eyes of the shareholders is something that I'm afraid I'm not in a position to commit right now.
Absolutely. I mean, I'm pretty much on with you on that. And my last question, Mr. Shankar, coming is with regards to the vendors that we have as well. Any new additions that we're expected to see in the coming quarters?
So, on a lighter note, we are still coming to terms with 230 global vendors. You can imagine, Hiral, it's full. You can imagine the kind of vendors, HP, Cisco, Oracle. See, I mean, it's a laundry list. So to answer your question, there are three areas where one can expect, and we are working towards it. One is on the IT enterprise space. There will be brands, and we are constantly adding brands, but this will be more in the software, security, analytics, etc., IoT, and so on. The second is in mobility, particularly India, where there is an opportunity for us to build our bouquet, like what we have done in outside India. So there is a clear opportunity there. The third for us is, please recall what I said, that we are also trying to look at businesses beyond IT and mobility. So there will be some new areas, but which will leverage our logistics capability, our ability to give credit, collect money, our ability to provide services. So a lot of these will be very useful as we think about some of the other new businesses which we plan to foray into.
Absolutely. I think it looks to be like a good journey from here on that all of us are riding on. Thank you, Mr. Shankar, so much for joining us on the show. It was a pleasure to have you, and waiting to see Redington scale new heights and meet and probably exceed Vision 2025 as well before we reach there. Thank you so much. Good luck, and wish to speak to you soon again. Thank you.
So sweet of you, Hiral. Many thanks for your time, and many thanks for giving this opportunity. It's a pleasure and delight to have interacted with you. Good day to you. Please stay safe. All the best to you.
Same to you. Thank you so much.